Some believe that if Joe Biden becomes the next US president, investors in gold as well as shares of Chinese and clean energy companies will be reason to cheer. If President Donald Trump is re-elected, in contrast, those investments will be hard, but shares of oil, gas and coal companies should rally. Don't believe all you hear. The analysts making them have rarely taken the trouble to actually test them. Hi there, welcome to Investors Game. Today, we're gonna talk about where will the market go if Trump or Biden wins. And give us a thumbs up, that helps us a lot, so let's get started. Disclosure. I'm not a financial advisor. These videos are for educational purpose only. Investing of any kind involves risk. While it is possible to minimize risk, your investments are solely your responsibility. I am merely sharing my opinion with no guarantee of gains or losses on investments. Also, this video doesn't invite you to vote for Joe Biden or Donald Trump. Remember, it's just for recreational purpose. Now, let's get started. It's not about whether Biden wins or Trump wins. It's also about who takes the Congress. If the Senate or House or both go Republican, then that could frustrate Biden's agenda quite a bit. The Democrat nominee has an extensive platform, so here are a few ways a Biden win may impact the markets. First, we're gonna understand that Joe Biden is one of the biggest investors in cannabis stock, and Democrats has been trying the full legalization of marijuana in the US. First, first factor to impacting the market can be repealing tax cuts. David Cass, a clinical professor of finance of the University of Maryland, speaks to Biden's plan to reserve the tax cut in 2017, which slashed corporate rates from 35% to 21%, which is good because they want to get a loan cheaper price. But Biden has called for raising the corporation rate to 28%. The increased tax rate will result in lower profits and likely lower share prices, and this effect might be more than offset by a larger fiscal stimulus package passed by Congress and better trade relations with countries in Europe as well as with China. Expanding Obamacare. Biden has vowed to expand Affordable Care Act, the healthcare overhaul that former President Barack Obama signed into law in 2010. Typically, this will be bullish for the healthcare stocks, such as pharmaceuticals and biotech firms, but this positive effect could be potentially offset by a focus on lower drug pricing, at least when it comes to Medicare, at a crystal clear priority for the Democrat nominee. Medicare is the federal health care insurance program for people aged 65 and older, and for those with certain disabilities. The Biden plan will repeal the existing law explicitly barring Medicare from negotiating lower prices with drug corporations. This in turn might lead to a power profits for pharmaceutical companies and low share prices. One can look to recent history to see that drug makers, especially some biotech companies with widely expensive therapies, can be very sensitive to the electoral landscape. Although Biden's plan in healthcare may be a bit more nuanced, drug companies are certainly sensitive to politics. That said, healthcare is a diverse sector, and Biden's policies may benefit other corners of that sector. Next, infrastructure and energy. One of the centerpieces of Biden's platform is focused on the infrastructure spending and investing in sustainability and clean energy. Eventually, we can see an infrastructure package totaling over $1 trillion. This could benefit the industrial and material sectors that produces heavy equipment or produces materials for roads and bridges. We think a Biden victory significantly accelerates the trend toward environmental, social, and governance investments. Tesla, although already richly valued, will see its business benefit from EV-friendly policies. And while by no means the only two utilities investing in renewable energy, NextEra Energy and Xcel Energy, it stands out as several names in that sector, with a growing focus on wind and solar power generation. Also, Biden has said that he wants to change interest rate, and change in interest rate can have both positive and negative effects on the markets. Central banks often change their target interest rates in response to economic activity, raising rates when the economy is overly strong and lowering rates when the economy is slushing. In the US, when the Federal Reserve Board, the Fed, changed the rates at which banks borrow money, this is a ripple effect across the entire economy. The effect of interest rates on inflation and recession. Whenever interest rates are rising or falling, you commonly hear about the federal funds rate. This is a rate that banks use to lend each other money. It can change daily, and because this rate's movements affects the other loans rates, it is used as an indicator to show whether interest rates are rising or falling. These changes can affect both inflation and recession. Inflation refers to a rise in price of goods and services over time. It is the result of a strong and healthy economy. However, if inflation left unchecked, it can lead to a significant loss of purchasing power. How interest rates affect the US stock and bond markets. Investors have a wide variety of investment options. When comparing the average dividend yield in a blue chip stock to the interest rate on a certificate deposit (CD) or the yield on a US Treasury bond, investors will often choose the option that provides the highest return or rate. The current federal funds rate tends to determine how investors will invest their money, as their returns on both CDs and T-bonds are affected by this rate. Warren Buffett once said, "The interest rate will determine where the market will go. If interest rates increase, the market will move to bonds. But if the Fed keep low interest rates, it's cheaper for investors to invest in the stock market because offer a better return when interest rate is low." Rising or falling interest rates also affect consumer and business psychology. When interest rates are rising, both businesses and consumers will cut back on spending. This will cause earnings to fall and stock prices to drop. On the other hand, when interest rates have fallen significantly, consumers and businesses will increase spending, causing stock prices to rise. Interest rates also affect bonds prices. There is an inverse relationship between both prices and interest rates, meaning that as interest rates rise, bonds prices fall, and as interest rates fall, bonds prices rise. The longer the maturity of the bond, the more it will fluctuate in relation to interest rates. One way the government and business raise money is through the sales of bonds. As interest rates move up, the cost of borrowing becomes more expensive. This means that demand for low-yield bonds will drop, causing their price to drop. As interest rates fall, it becomes easier to borrow money, and many companies will issue new bonds to finance expansion. This will cause the demand for higher-yield bonds to increase, forcing bonds prices higher. Issuers of callable bonds may choose to refinance by calling their existing bonds so they can lock in a lower interest rate. So interest rates affect the economy by influencing stock and bonds prices. However, it is important to understand that there is generally a 2-month lag in economy, meaning that it will take at least 2 months for the effect of an increase or decrease in interest rate to be felt. By adjusting the federal funds rate, the Fed helps keep the economy in a balance over the long term. Understanding the relationship between the interest rate and the US economy will allow us to understand the big picture and make better investment decisions. Now that we know Biden's plan, let's see how Donald Trump has impacted the market since he has been elected. The S&P 500 returned 19.3% with dividends reinvested from the close of November 8, 2016, when Trump was elected, through the close March 16th of 2020. That is a sobering number when you consider that the benchmark index returned 31.5% last year. The Dow Jones Industrial Average returned only 10% for the same 3+ years period. The Nasdaq, which is heavily weighted to the largest technology companies including Apple, Microsoft, and Amazon, returned 30.9% the last year. Digging further, the S&P Mid Cap 400 was down 6.8% and the S&P Small Cap 600 was down 9%. Back to large cap stocks, here are 20 stocks in the S&P 500 performed best for the November 2016 through March 2020. The first thing to observe here is that in first place we got MED stocks that increased 453%. And if you don't know, it's a company that develops computer processors and related technology for business and consumers. Remember, all of this information is before the crash. After the crash, we got the top companies such as Tesla that increased its price for more than 400%. But that happened after the crash. But the largest company still had a good growth, such as Apple with 129%, Microsoft 139%, and Nvidia, that also is a technology company, had 180%. Because we have seen that Donald Trump don't support healthcare plans, we see that companies related to oil or gas are more profitable than companies related with drugs or healthcare companies. Now here are the 20 worst performance in the S&P 500 since Trump was elected from November 2016. As I said before, we're gonna see a lot of pharmaceutical companies that are struggling. Also, companies that work with energy were affected for that reason that Trump would rather invest in oil or gas than in clean energy. Companies such as Noble Energy, Devon Energy are the most affected companies in Donald Trump period. Also, Republican administration have traditionally been friendlier to large banks than Democrats ones, and Trump's slashing of corporate tax rate in the Tax Cuts and Jobs Act was particularly beneficial to banks. Stocks such as Bank of America, JP Morgan Chase, and American Express are the base for Donald Trump because they are mirror the US economy. So if the S&P 500 increase, they will also increase their price. The election aside, JP Morgan is attractively priced in an otherwise expensive market and pays a dividend yield of almost 4%. JP Morgan would likely fare better under a Trump administration, but it probably wouldn't do too poorly under a President Biden either. As a general rule, Republican administrations are less likely than Democrat administration to issue stricter banking regulation. This matters because following the COVID-19 economic upheaval, the next president will be in a position to address consumer bankruptcy protection and a host of other issues. In conclusion, these are just speculation that if Biden wins, stocks such as Bitcoin, healthcare companies, cannabis, and clean energy companies could have more success than banks or indexes because as we said before, Democrats have tried to increase their interest rates, causing that banks have to charge more for each mortgage. That means less money for banks and people. On the other hand, the Republican side, if Donald Trump wins, stocks such as Bank of America, JP Morgan, Dow Jones, S&P 500, and oil companies could have more success under Trump's administration. Why? Because he's pushing the Fed to keep interest rates at low level, because he knows that with big unemployment rate, if the Fed increased the interest rates, people wouldn't have money to pay even the interest for the mortgage. So it's not a smart idea to increase the interest rate if people don't have extra money to survive. For that, the Fed decided to keep low interest rate until 2022. If you like this video, don't forget to hit the like button. Let me know in the comment box, do you know where will the market go after these elections? Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.